My name is Tyler Russell. I'm the National Grain Marketing Services Manager for Cargill. My goal is to help farmers make better grain marketing decisions. Well, market direction is one of the legs of the stool is very important. This is what is causing that commodity to go up or down. And generally look at market direction is that there's three main drivers to price. The first main driver would be what's the supply and demand or the fundamentals of that commodity looking like. This goes back to basic economics where if you don't have a lot of that commodity or you don't have a lot of stuff, the price generally tends to go up. Or if you have a lot of a commodity sitting around the world, generally the price tends to go down. So you need to look at the fundamentals of a crop or a commodity because that has one driver on the price. However, there are two other drivers on what impacts the price, and the second one is what's happening in the world, often described as the macroeconomics of a commodity, but what's happening in the US or in Europe or in just the broader economy. Because if we go back in history to times where, 2008 or other times where we had some significant market correction in the outside markets, that had a tremendous factor on the commodity markets as well. It's not like the supply and demand of wheat or canola or some of these crops changed during 2008 when we had the credit crisis down in the States. It's just that a recession hit the States, which drove prices down for short term. So you can't forget about the macro, the bigger economy as well, and how do you find that information out, because that can drive prices as well. And the third thing that can drive prices up and down, and people don't necessarily realize this, is it's called the technicals. Often the index funds or the commodity funds or the hedge funds they're called, oftentimes they don't necessarily look at the supply and demand or the fundamentals, but they start trading off of charts and key support and resistance levels in the charts. This is what creates daily movement in commodities. Oftentimes the supply and demand maybe only changes every month or something like that, but the market still trades based on other information going on. So there are billions and billions of dollars that these hedge funds and commodity funds control that they're moving around in the ag markets. So you do need to know what these big money or the big money is doing, because they can drive a market up and down. So summarize, market direction is very important. There's the fundamentals, there's the macroeconomics or the global economy, and then there's the technicals. Probably the third leg is risk management tools. And oftentimes farmers are great at understanding their individual situation and their costs. And they can often find market direction somewhere and know kind of what the market's doing. But now so what do I do? What's the tool that I use to help mitigate my risk? And as you look through this, there's an upwards of 15 different type contracts that all work a little bit differently to help manage a producer's risk. And they range from flat price deferred delivery type contracts, which lock in a price, to fixed basis contracts. Some of them are averaging type contracts, and some also are minimum price contracts. But we find that it's very important to understand how these tools can help you in your plan. And often people say, well, how can these tools help me? Well, it's very important to determine how the tools work. Some of them work very good in uptrend type markets. Some work very good in stable markets, and some work very good in down trend markets. And so you have to take the right tool off the shelf in order to make a very successful grain marketing plan. I'll tell you an example. You might know that your costs for canola, so to speak, are $6 or $7 a bushel. And you know that the market is going to go up. For some reason, you know the market's going up. If you go out there and lock in a deferred delivery type contract, you probably could have done some things different to maximize your price. You probably could have done other contracts such as price protector calls or fixed basis contracts or pace setters that could have allowed you to achieve a higher price, because it's very, very hard in today's environment to pick the tops and to pull that trigger. So oftentimes you can use these different risk management tools to help you smooth out when is the right time to pull that trigger. There's lots of different contracts that people probably aren't aware of. I would say that you do have to remember that as a producer, you have two fundamental advantages over those hedge funds and grain companies and different things. And the two fundamental advantages that you can't forget is you grow the crop, so you're always going to have that crop growing in your background as a backstop. And the second thing is that you're very fast and that you can get in the market very, very quickly. Unlike funds that have to move billions of dollars around, it's harder for them to get it in and out very quickly. So a couple contracts that farmers can use, one would be, for example, an averaging contract. Now, oftentimes people think of the word averaging and get the wrong taste in the mark, that they want to be better than average. However, as an example, because we didn't necessarily know where the market's going to be going, no one can predict the future. You don't know if the market's going to be going up or down. Some people can use an averaging contract. And for example, from November 2010 to November 2011, so a whole year, we could have done an averaging contract over that period. Well, if anyone would have guessed that the average for that period was $572 a ton, there's not many producers that marketed their canola above $572 a ton during the year for a number of different reasons. So when you look back at who's average now, sometimes we get the wrong taste of an averaging contract, but yet that's a brilliant contract to use where you don't necessarily know when to pull the trigger at all times. Why don't we average a little bit of sales and make incremental sales every day? The other contract that people are not aware of, and we talked about the speed that producers can move in and out. Let's say that the market trend changes or something happens in the market that significantly affects the market conditions. The advantage of a producer is if something does change, you can go back in and start attaching and making new contracts, whether that's making options or adding options to some of your contracts that maybe create floors in place, maybe allow you to stay in the market later. And you can do this at different times in the market. So taking advantage of those different contracts, such as a price protector call, when you can go back in and attach a call if you want to stay in the market, are things that people maybe need to get more education on and know how they work, because they're very, very important risk management tools. Oftentimes I hear, can I make my own act of God? I would sell more production if I could have an act of God. Well, there are ways to make your own act of God. Is it free? No, it costs a little bit of money. But if that's the contract that you need in order to lock in some very, very good prices and contracts, then that's a great option to look into. And how can I make that contract? Because those options are available to farmers. They just need to go out, search for them, and understand how they work and are implemented.